Hello, welcome to Accounting 2010 Chapter 8 videos. In Chapter 8, we're going to be discussing receivables. And receivables occur when we want, as a company, to broaden our sales, broaden the customers who can buy our products or services. And we can do this two different ways. We can set up an account receivable, meaning that we have the right to receive money from these clients. We're allowing them to charge in the short term, and we will have a right to receive payment once we have performed our services or delivered our products. And this type of a receivable is usually short term, 30 to 90 days. It usually does not necessarily charge interest, and we are able to receive our money pretty quickly. The second type of receivable is a notes receivable. It is more formal in nature. Generally, you're going to have clients sign an agreement. You may receive interest because you are allowing them to charge for your products or services for a longer period of time. And so we're going to treat each of these receivables a bit differently in this chapter. The first we're going to talk about is accounts receivable. And some of the issues with accounts receivable is determining who are we going to allow to charge our products or services. Who are we going to be able to trust to pay our money back at a later period of time. But the bottom line is, and unfortunately, not all people will pay us back. And how are we going to estimate who will and who will not? Well, we can look at historical data, we can look at the economy, we can get some industry reports to determine the percentage of folks that will never pay us back, but we're not necessarily going to know who they are until that event occurs. And so we're going to have to set up some generic accounts to set aside estimations of those accounts which will never be collectible. And so we want to do this so that we can match any future bad debts to the period in which the sales were created. And to do so, we are going to have to be talking about three different accounts. So these are the accounts that are going to be talked about in the accounts receivable section of this chapter. The first is the accounts receivable account itself. We're going to be aggregating all of those accounts in a general accounts receivable. In truth, we keep separate records of each person who owes us money so that when they make payments, we can reduce their payables, how much they owe to us. We can also look and see, in fact, if they do not pay us, who we have to go after to get our money. So we're going to be dealing with the general accounts receivable. Then we're going to set up another account, and that is called the allowance for doubtful accounts. It also can be called the allowance for bad debts. And we call this a contra asset account. And remember, we've heard this term before with the depreciation account, the accumulated depreciation. And contra asset accounts show us how much we expect the asset account to be reduced. And by setting up this allowance account, we're going to set aside a dollar amount. It's not actual dollars, but a dollar amount that will be a negative to the accounts receivable, and that will allow investors and creditors, if you take the accounts receivable minus the contra asset allowance for doubtful accounts, creditors and investors will be able to see what our estimated net realizable value, NRV, how much we really think we're going to get out of that accounts receivable will be. And then we will also then be able to, when we make the sales, those credit sales, we're going to be able to take a percentage of those sales or a percentage of the amount that's due to us and write it off in the period of which the sale was made to a bad debt expense, a bad expense, and this should say bad debt expense. And that is where we can take that off on the income statement to match our revenues to our sales. So there are three ways that this chapter, or that we will discuss, of how to estimate what our uncollectible accounts will be, our bad debt expense per period. The first is the income statement approach, and it gets its name because it's going to look at sales. Sales is found on the income statement. Sales, we're going to take a percentage of our credit sales, and we will write that off as a bad debt expense for the period and put that amount into the allowance for uncollectible accounts. The second and third ways are considered balance sheet approaches. And the balance sheet approaches are because we're going to be looking at the actual receivable accounts. And the receivable accounts can be approached in two different ways. The first, we're going to take a percentage of the total receivables at the end of the period, and that will be what we believe we will not be able to collect, a certain percent of those end of the period receivables. The second is an aging of receivables, and that method is going to analyze each individual account. All the folks who owe us money, we're going to look at them and we're going to say, well, gosh, George has owed us money for 30 days. There's a pretty good chance he's going to pay us. Sally has owed us money for 90 days. The chances of her paying us are somewhat less. And then you've got Jose or Bill or Jamie, and they have owed us money for 90, 120, 180 days. And the chances of those folks paying us are less yet. And so then we will apply a higher percentage of unlikelihood that they will ever pay us. So the differences in the methods are fairly substantial. In the income statement approach, we're just going to be simply taking a percentage of the sales, and if there is a balance in that allowance account, and I'll be demonstrating this in some problems, if we have a balance from the previous year in the allowance account that perhaps last year we had thought that 3% of our sales, our credit sales, would not be collectible, and really only 2% ended up not being collectible. We've had a pretty good year. Well, maybe we're going to want to adjust that percentage amount, but we are not going to care what is in the allowance account. We're just going to adjust the percentage from year to year. In the balance sheet approach, whether we use the aging or percentage of receivables, we will be taking into consideration the amount in the allowance account. And we will have to be trying to hit a certain target. This will become clearer as we go on. So let's look at the income statement approach. This is very simple. The income statement approach simply says you're going to take the total sales or total credit sales, whatever your problem tells you. Theoretically, it should be the credit sales, but sometimes your problem isn't quite so clear. But whatever your problem tells you to do, you're going to take that number, your total sales or credit sales, and multiply by the percentage of sales that we deem that we may never collect from our customers. And your problems will give you this percentage. When you take that calculation, total sales or credit sales times the percentage, this will be the percentage that we will charge to the bad debt expense for the year, and that will be the debit, and the credit will go to the allowance for uncollectible accounts. And this way we will be able to match whatever percentage of sales we've had to the amount that we believe we'll never be able to collect. And under the percentage of sales, here is going to be the journal entry. We're going to have bad debt expense. Again, remember, we're going to take the percentage of the credit sales. They're going to give us the percentage. They're going to give us the sales. We're going to multiply it. We're going to put the debit to the bad debt expense. We're going to take that off on the income statement, and we're going to credit the contra asset accounts, allowance for bad debts or allowance for uncollectible accounts, and that will offset our accounts receivable. So if we look at the balance sheet, what we would see would we have accounts receivable minus that allowance that we had determined here, and it will give us a net realizable value. And what that says is, okay, creditors and investors, we had allowed folks to charge, and this is what we have in our accounts receivable at the end of the year. But over the course of the year, we have believed, based on previous sales and collectability of credit sales, that there's going to be an amount of money we're never going to collect. We call that the allowance for bad debt. It might happen in 1 year or 2 years, whenever we determine when we're never going to collect it. And that will give us what we really think we're going to get, what we really think our asset is. So that gives us a lot of information. That same calculation can be moved to the income statement, and now we've got sales, and we've taken a percentage of those credit sales, and we've said, you know what, even though we allowed folks to charge and we don't know who they are, we know historically that some of those folks will never pay us, so we're going to take a bad debt expense based on those sales. We're going to subtract it out to give us really what we believe our net income will be. So we've got our balance sheet showing the charges that we allowed, how much we don't think we're going to collect, how much we really think we're going to collect. We're showing our income statement, showing how much we had in sales, and that those sales had some credit extended, and of that credit, since we don't know who's really going to not pay us, we're going to have some bad debt. We're going to take that off and really give a good reflection of how much we're going to really collect. And that's what our net income will show. And then if in the next year or two we actually realize who isn't going to pay us, we can actually allocate it. And we're going to take it out of that allowance account, and we can write off the person who did not give us the debt or give us our payment. In this case, I chose Kyle. He was a student of mine a few semesters ago, and he was quite silly, so I chose him. And what this says is Kyle charged. I allowed Kyle to charge in a previous year, and I thought he was a really great guy. And it came down the road that he never intended to pay me in the first place. So I didn't know it was Kyle when I allowed him to charge. I wrote it off in the allowance of bad debts. But when I found out Kyle wouldn't pay, I took his account off my books, and I credited allowance for bad debt. So now, this is a really important point. When we're talking about the percentage of sales, we don't care if it's had a previous balance. We just don't care. We're just going to calculate the amount and adjust percentages in the next year. But under the percentage of receivables and aging, we do care if there was a previous balance. And so in the next video, I'm going to pick right up there, and I'm going to talk about the percentage of receivables and the aging of receivables and what the difference is in calculating those numbers.